Welcome back to Infinity Podcast. Today I'm joined by Andrew Dunn, Managing Partner at VAC Development, an asset-class-agnostic real estate investment and development firm focused on yield-driven opportunities across the Southwest and Mountain West. Andrew operates across acquisitions, capitalization, and business plan execution, and has built his platform through deep investor relationships, programmatic partnerships, and a disciplined focus on development spread and yield on cost. Andrew, thank you so much for coming on the podcast. I appreciate it.
Hey, dude, appreciate you having me. Thank you so much.
Andrew, for those listening to the podcast who do not know your background, how you got started, could you tell us a little bit more about how you fell into real estate in the first place?
Yeah, I was dating this girl up in college, and then her dad said, come work for me. And I was like, okay. And essentially, we just, kind of hit it off. He had this family office. He had a partner of 50 years. And I was like, what do you do? He's like, I do commercial real estate. And I was like, okay, well, how do I learn it? He's like, well, how about you start, trying to find me some fix and flips. So we did about 75 or so fix and flips. I found the money, found the deals, put them together. But I was like, all right, this is cool, but I want to do large-scale commercial developments, warehouses, apartment buildings, mixed-use projects, retail, office. And that's kind of where I was always kind of learning from him. But I didn't really jump in with both feet until kind of a couple years with him. And that was I started in June of 2018. I really jumped into commercial hardcore with him at the end of 19. And then we started VAC Development in January of 22. And, he never really syndicated dollars. He was a part of that era where you can go to a bank, they'd give you 105% by signing a personal guarantee, or he had a couple big family offices backing him. One was called the Hollow family out of Miami, and then there's another family called the Kraus Companies out of San Francisco. And so basically it's we would double escrow vacant office buildings, options to purchase, tie up a piece of land, flip it, and then, just more of the value add stuff where it was mismanaged. There was vacancy, fill it up, raise rents, put a pretty bow on it, and then take it out with an institutional broker and sell it. It's always been a merchant strategy where you're in and out. It was never a long-term hold for us. But yeah, that's kind of how I started.
Tell us more about your passions behind commercial real estate. Why? You could have gone down the single-family, multifamily space. Why commercial real estate? Why industrial? Why retail specifically?
Yeah, so I think for me personally, I don't it's not that I don't like people, I just don't like dealing with personal people in the sense of hey, everybody needs a place to live. Yeah, that's accurate. But at the end of the day, I think there's a certain breed of people who like that, and then there's a certain breed of people who like commercial real estate. I like the entrepreneurship of commercial real estate, understanding that it's more financial oriented, and you're more underwriting the person. Hey, can you pull off this business? Are you trying to expand? What's your thesis? Why do you think you'll grow? Why do you think you'll be successful in this business? And I also just like the triple net game. There's a lot more pass-throughs on the nets. You can charge an apartment's RUBS or everything, but there's no real control over your expense cap in residential. Insurance goes up. Well, dude, that really affects your bottom line. Whereas hey, insurance goes up, I do a CAM reconciliation, and I can bill that back to my tenants on our retail and industrial properties. Yeah, there's sometimes some leakage on the retail if you have a national credit tenant that has a CAM cap. But more often than not, we really try to focus on mom and pop businesses. And I just appreciate that, small business entrepreneurship kind of side of the game. And it's more service oriented, and I just like it, honestly.
Makes complete sense. Andrew, when I first started the podcast, I mentioned that VAC Development was an asset-class agnostic real estate development and investment firm, and you guys are operating across the Mountain West and Southwest. Tell us more about what active projects you guys have now and what your strategy is in 2026.
Yeah, I think, like I said, we've done a lot of retail and industrial, but previous to the last kind of couple years, we've done apartments. Again, I told you about the homes and office buildings. I think there's a really great window here to build small bay and shallow bay industrial buildings. We got 2 projects currently under development. I'm going for my 3rd. We're building up a pipeline to do 7 or 10 of these developments in the next couple of years. And then I would say there's a keen focus on adaptive reuse of retail. Meaning like, hey, repositioning mismanaged strip centers, grocery anchored retail, bring into the new fold, backfill in the box space with more experiential or gyms, and then, catering to a higher end demographic, as we're big believers in the K economy. So those are really the 2 key areas of focus. Our core markets are Vegas, Reno, and Phoenix. And then we made our first acquisition in Boise in Q4 of 2025. And we're trying to get into Salt Lake, Denver, and then maybe looking a little bit further east. We just don't feel like we can do California. We've tried a bunch. I'm a California native from Orange County. I just don't think in the current political climate it's worth our time or effort where we can go and operate in other places.
What have been the biggest challenges that you faced when scaling VAC Development? When you first started out, what was the biggest hurdle that you had to overcome?
Money.
It's for everyone.
I think it's a chicken or the egg. Money wants to see that you have deals, but then the deals that you're trying to buy, people want to see that you have money to close those deals. So I think we've utilized the reputation from our previous partnerships and our ability to transact and to close and our sophisticated kind of institutional way to run things, but not have an investment committee. Like, I write offers on the spot. Fastest offer I ever wrote was within like an hour of seeing the property and the rent roll. I'm a quick back of the napkin kind of guy. So I think it used to be like capital, and I think it's now capital's not the issue, as we now know what the capital is wanting. It's just, can you keep a pulse on what that capital wants consistently? Because I think, real estate is a long-term investing game more often than not. But the capital's mentality can shift on a quarterly basis and how they're allocating. And when you got a widget, like I feel like it is in this small bay, shallow bay, and the value add retail, like that's all I want to focus on for the time being until office is right. Like, I do believe in the next 12 to 24 months that capital is going to be coming in. I'm not going to enter at the bottom. I'm probably going to enter when the floor has risen. But at least I know I can get money for that. But I think that's some of the best cash on cash coming up here in the next 12 to 24 months with where rates are at. There's more liquidity coming in. But I'd say scaling that money, and then now it's just having that company culture and finding those resources for people to be bought in, right? Like, we're a 24/7 operation. Like, it's a lifestyle. This isn't a 9 to 5. You can't survive with me on a 9 to 5. Like, if I text you at 6 a.m., 5 a.m., I'm also texting you at 9 or 10 o'clock at night. I don't expect you to respond, but I expect you to promptly kind of check your phone and respond via email.
Thank you. We're seeing a lot of capital being deployed into data centers at the moment. And it's crazy because obviously that's taken off. What asset classes do you see emerging within the next real estate cycle? Let's say 5 years.
Yeah, I think it's office. I think truly you continue to focus on the AI contrarian play, which is essential service retail. People need their haircut. They want to get their nails done. The little shops, goods and services. We've kind of surpassed the brick and mortar crisis of the Amazon era. And then just in conjunction with what you said in regards to data centers is all the industrial, like I call them Klingons. The HVAC guys, the plumbers, more of the small service orientated stuff. And then you have some bigger kind of widget manufacturers. I think those are going to be very keen, but I think the bloodbath of office, not high rise, but like in certain pockets and good suburban growing areas, is going to be still very keen. And just our infrastructure and how communities grow. So I think good suburban, high class A office is going to do very well. And I think it's being bogged down by the overall negative sentiment and delinquencies in office in general. So I think it's a great play.
When you and I first met at the IMN event, I was talking to you about how emerging sponsors should go up to equity and position themselves to develop these programmatic relationships, whether it be with family offices, etc. My question to you is, how should emerging sponsors in 2026 and beyond be looking at developing these relationships, especially with the way the capital markets are right now and everything that's shifting?
Yeah. So it's going to be quite a bit for me to answer that. I think the biggest thing is focus on your current home market. I think for you to say, if you're in Los Angeles, just as an example, and you're trying to go do deals in Texas, don't be in Los Angeles, go to Texas. You know, you fly back to Los Angeles to get that money to go into Texas, but you got to be on the plane. So I think you got to find where the money wants to be. Like, let's just use a lot of Texas is growing, and, you know, Dallas, Austin, kind of some of these other places. So it's like, pick a market where you see growth and you can find that rising tide, but you have to know your asset class. I'd say find a strategic partnership with somebody who's a little bit older and has the track record. It's very keen and helpful because if you're, like, I run into that. Like, I'm 30 years old, right? So for me to be 30, why have I been successful? Okay, I have a partner who's 40 years older than me and a partner who's 10 years older than me, and we all complement each other. So I leverage the 70-year-old's balance sheet for loans, his experience of 50 years of doing real estate in multiple markets, asset classes. But I'd say with equity, you're not just going to be able to go to a family office and say, hey, I have this deal, like, go give me money. You have to think of it in a 12 to 24 month horizon period to go get that first check from a single check writer. And you're going to have to be scrappy. Like, you're going to have to, in my opinion, to go get an institutional check out of the gate without having an institutional partner is a very uphill battle. Yeah. I would say you got to focus on that syndication initially to get some of your projects off the ground. But I'd say strategic partnerships is the best way to get into the game. And listen, usually younger guys like me, we have no money, right? We've made money by making partnerships. Could we have made more on our own? Maybe, but the chance of doing that was way lower than playing the long game and just taking base hits and doubles that turn into triples and home runs when the market goes up, right? But we're in a very volatile time, like you said. So I'd say it's all about who you partner with, and you better know your deal, and you better know your market like the back of your hand. That's the one thing you must do.
Would you have done anything differently when it comes to raising capital when you first started out in real estate?
I think the only thing I could have done differently is gone to try to go work for a Trammell Crow or a Blackstone, right, and have that pedigree attached to my name. But then I would have been a cog in the machine. I would have never gotten the operational experience like I've done. So, like, I think to me, I viewed my real estate journey as parabolic, meaning the first 10 years are going to be a grunt, but then after that 10, that compounding effect that I'm going to have. Like Albert Einstein says, the eighth wonder of the world is compounding. And I think that's really going to be advantageous because I've been playing the game not for when I'm 30, but I'm playing the game for when I'm 50 and 60. So I think if you have that mentality and that's how you view relationships, you're good. But otherwise, I don't think I would have, because I learned how to syndicate. I've learned how to deal with family offices. I've learned how to do institutional equity, bank debt, debt fund debt, life co, ground up construction, value add. Like, I've never been able to, like, do a stabilized deal unless I'm refinancing. And doing a stabilized deal is like a cakewalk to me now because of all the problems we've had to do. So I don't think it would have. I think it's exactly where I needed to be.
That's a great answer. It all works out.
Yeah.
Andrew, what have been some of the biggest challenges that you personally have faced within the development sector?
Trusting what somebody tells you. I think somebody may say, hey, it's going to take 3 months. Okay, what happens if it takes 5 or 6? Oh, that would never happen. Okay, well then it does take 5 or 6. Were you the guy who took the guy's word for it? Or did you plan that it would take longer? Because I think time kills all deals. We've heard that saying a lot. But I think it's setting the proper expectation by being in the market and not just getting one quote, getting 3 quotes, 5 quotes, and people get irked about it. But that, guess what? You're doing your due diligence on the market, asking the right timelines, having even the capital to spend to go do that due diligence, right? Like, you may spend $50,000 to $100,000 on a deal and before you even know if you have a deal. And then sometimes you have to be ready to walk away after you've spent that money. And that's a very painful thing, that you're spending at an amount of money that most people make in a year, if not like in a couple year time frame, right? Depending on the scale of the project. So you better be prepared to write off that loss, factor in that loss, and knowing that every deal you tie up, you're not going to close. I've ran into environmental issues. How do you navigate those? Do you even want to navigate those? Property issues, HVAC, roof, parking lot, putting in fire sprinkler systems, asbestos remediation, crazy tenants, evicting tenants, non-judicial lockouts. Like, I just feel like the timing expectation and what things actually cost and how to execute, you can't learn that by reading a book. You have to learn by failing and executing and being in the market.
Right now, real estate development, specifically in the multifamily sector, it's very difficult to make deals pencil in most markets. When do you see the environment improving, and what markets do you see taking off in the future?
You know, I like to use the kind of perspective that if you let developers build, they will. And I think Austin, Texas is a great example of that. There was like everybody just kind of built and rents have gone down almost 30%. Now, does Austin have a demand issue? No. It's just the supply way outpaced the demand, just like big box has done in the broader national sector and industrial. You know, we're starting to see industrial kind of tick back up on the big box side now that these bigger bombers have gotten filled. I think on the multifamily side, some of these older buildings need to shut down. Right? So like these buildings that are being built today, they are called Class A, but they're really Class B style product. They're just called Class A because they're new. And I think in 10 years they will be down to Class B. So I think it's getting rid of the Class C supply, the other class like stuff, and then the cities and jurisdictions have to shut these buildings down or force landlords to upgrade these buildings. But I think in multifamily, you got to really follow the jobs data and migration patterns. It's not even just jobs data anymore. It's straight up migration patterns, and you got to find a cheaper way to build. Is it a modular thing? Do you go further out where the land is really cheap? You're not paying 30, 35K a door, but you're paying 5 or 10K a door for the dirt. And can you do a walk-up product? Like if you could stay away from elevators and go on the outskirts and provide an affordable or attainable product, not because it's a key distinction, right, but an attainable product, I think that's what makes sense. But it's tough. There's still a lot of supply issues. I think the 10-year just dropped below 4% over the last couple of days. That's very helpful. Like, to me, multifamily is probably the most, all of commercial real estate is like finance oriented and sensitive, but I think multifamily is the most sensitive to financing because that's what really triggers that spread. Because in my world, I'm trying to yield to a mid-7 return on cost, and multi, you guys are you're returning to a mid-6 if you're lucky. It's really a low 6. So it's like if I'm yielding to a low 6, I got to really have, a great basis on my financing, to be able to go trigger that arbitrage on cash flow and financing. And I think you just have to have a further control on expenses. I think there's just been a lot of expense fluctuation happening over the last couple of years with insurance, expense growth for just random services, and I think AI is really going to help it, and streamlining a lot of property management, cash flow systems, accounting, bookkeeping, and just predictive analytics, more or less, on your rent.
You mentioned migration. You mentioned migration patterns was one of the key things that you should look at when evaluating multifamily. What are some of the key metrics that you look at when evaluating commercial, specifically industrial and retail, when exploring a new market, etc.?
Yeah, I think it depends, right? So I really, on the retail side, it's vacancy, right? Like, I think on vacancy, we want to go buy in submarkets that are pretty tight. You're seeing consistent rent growth. So when I'm buying retail, I want good household income. I want to try to be above $80,000 a household as best as I can. And then in that regard, I just want to look at traffic, right? I'm very cognizant of traffic data. I usually like to know less than 25,000 cars a day on the main drag where the frontage is. Really prefer over 30. And then I just want to look for a more land-constrained market. It's very hard to build retail right now. just because of some of the supply chains with hoods and restaurant infrastructure have 3 or 5x since COVID. Not like it hasn't grown at the rate of inflation; it's grown way above that. So kind of finding that repurposement on the retail side, standard supply and demand. It's not necessarily, and you also still look at migration patterns in retail. I want the continued influx of people, continued influx of housing coming to the area, and continued elevation of that demographic. In regards to industrial, Greg Panettone has a famous saying, when the tenants in market are 20% more than the supply, you go spec, right? You go and build. So I think to that point, it's an old school thought. I think that's kind of justifiable based on what competition or what industrial per capita you're at. But it's fundamentally about the tenants and market and why are companies moving there. Like, we're very bullish on Phoenix because we believe that's Semiconductor Valley. You have TSMC, you have LG coming into the market, you have Ancor, you have Intel, you have ASU breeding like 30,000 civil engineers and engineers every day. So it's like that educational infrastructure is keen for manufacturing logistics. And then where can you get to by a truck? How close are you to Los Angeles, Long Beach port, or how close are you to a major port? How close are you to like a certain populace of the U.S.? Like, are you targeting logistics, manufacturing, or service-oriented tenants that are more property identified?
Artificial intelligence is it's huge, right? In real estate, it's taking over, and I want to get your take on it and how it's affecting your current workflow and how you're using it with your investments.
Yeah, I think for us, Claude has been very keen. So for Gemini, so I use Claude and Gemini, and then like a little of like Grok. So I use Grok for like the real impulse, kind of like current state of the market because it pulls from X. Gemini, I think, has some of the best deep research for market reports, like overall market perspectives that you can really pull. And then Claude for more the legal, deeper financial analysis, Excel, deck creation for PowerPoint. And what we've actually just done at VAC is, engage with and everybody, like we're a team of 5, right, in our main office. So like everybody has a Claude, pro subscription, and then like our analyst has like the premium, right, because he like runs more of like the coding stuff. So for us, what we've seen is that we're actually reorganizing our database to all go through Claude. So it's like, hey, all of the LOIs we've ever written, all the lease drafts, like all the offers, all the property management, like all of our rent roll history, and what we've even done on the front end analysis is we do a financial audit. So instead of me having to go through all the financials, like we looked in like this like property we're buying's financials, and we saw, hey, this is the tenant that's most likely not going to make it. They're delinquent 12 times. Here's this issue. Hey, go through the phase 1. What are the risks? Go through the PCR. What are the true costs I'm going to spend? Or go do market research. What's the realistic rent? Who am I competing with? What's the ownership profile in the area? Like, it just takes so much of the grunt data collection and junior level analysis like out of the equation that allows us to do a lot more with less. And we're doubling down on it, like maybe shifting over from Dropbox to Box because Box is a better integration with Claude, doing a full like migration. Like we just got off of Syndication Pro. We're going to Agora because they have better kind of AI reporting kind of efficiencies. I have a reporting template or investment memos that can just be duplicated. It can write in my voice. So it's like a lot of this grunt design work is just being outsourced to like AI, and it goes 24/7. And it goes at a scale that no human could ever do.
Yeah. It's an infinite intern. That's such a crazy thing.
And it compounds and never forgets, right? If you set up the database properly, it never forgets. Yeah. So it's like, how could I compete with that as a human, right? I can't wait to just download, go up to the Neuralink and just really hive mind it up. So
yeah, it's kind of crazy. I'm always using like all these different AI platforms and softwares within my different computers, all running at the same time. It's amazing.
Yeah, it's killer, right? So Andrew, I think it does for land analysis too. But go ahead. Yeah,
I'm kind of confused because what I've heard from John McNellis, who's a famous real estate developer, he said the riches are in the niches, and that you find one market and one asset class and you focus specifically on that. How has VAC been able to be so successful with your asset class agnostic, and then you guys are operating across the United States?
I think for us, it's really we see a gap when other people don't. So it's like if I would tell you if I had more bandwidth, I would have gone into Austin and bought apartment complexes. I would have gone in there because I'm like, wait, fundamentally this doesn't, but like I don't have the full bandwidth and capital allocation to go full opportunistic. So we have a history of being opportunistic. We were one of the largest distressed commercial real estate buyers in Las Vegas post global financial crisis. I think for us, we have a history of, buying like land in certain places that are booming, industrial building, vacant buildings and filling them up. So I think for us, we've never been allocators, but then at the same time, there's pros and cons to that. The scalability is a lot harder, but I never get overweighted in an asset class. So like to your point, okay, if you're a multifamily developer, have you really done anything in the last 24 months? No.
No.
You haven't. So you've just been sitting on your hands.
Yeah.
Whereas me, I haven't been busier because retail's taken flight. Okay, I got out of office like at the right time. And the office we have is 97% occupied, so it's just kind of hanging on there, and I'm cash flowing. And then the industrial stuff, hey, we're grabbing into it. We got big box, we got mid-bay product, we got small bay stuff that we're really focusing on. So I think that's what's made us really good to be able to get these 20+% average investor returns on our merchant product. The opportunity zone stuff has also helped us, but it's like there's like to your point, like you're kind of asking me, like especially because you're based in Colorado, like how much multifamily could you really build? Whereas like me, okay, I can go build shallow bay in these different markets, and I equate it to like the old fisherman's philosophy. Okay, I'm going out, I'm a tuna fisherman in this one spot off the coast of Southern Cal. Okay, well, there's no more tuna. What do? I have two options. I either go find another fish that's economic, justifiably in that spot to go fish, so I don't have to leave that spot, or I got to go find another fishing spot, and it might be 2 hours north to go find the tuna. So what do you want to do? You want to keep going into a different market for your fish to keep chasing that opportunity, chase those migration patterns and those fundamentals that justify development or acquisition? Or do you want to you want to be the market guy? You know Las Vegas, you know Denver better than like anybody, and you can do multifamily, office, industrial, hospitality, self-storage in that market because you are the entrepreneur in that market. So I think we've more taken the entrepreneurial mindset, really know our markets well before going to the next one, setting up a name and network with the brokers, contractors, and people in those markets, and then go to the next one. And so really setting up our operation is like, if you got a hairy deal and there's problems, I'm the phone call, right? I just got one deal that we'll talk about. Like, I get the phone call because it's got problems, and I'm the guy who can solve them. That's the reputation we've kind of built.
Tell us about the most craziest deal that you've ever worked on.
Ooh, crazy in what way?
You can interpret it however you'd like.
I'm working on one right now. We'll see if I end up pulling it off. I'll give you a couple. This one, it's a 40,000 foot building in Reno. The guy's 95 years old. You
mentioned him to me.
Yeah, these books are kind of terrible. I'll close at the end of the month if everything kind of goes according to plan. I need to do fire sprinklers, half the roof, HVAC. He had a property manager living on the property. His wife, the property manager's wife, is one of the tenants. She's the one that's delinquent. And I feel like he was like pumping the books. Half the rent rolls month to month. He hasn't raised the rents in 20 years. The property is like built in the 70s and 80s. It's hodgepodge junk. But dude, I'm yielding it to a tenant. We've already negotiated leases 20% above our projection. So it's kind of worth it. I think another crazy one is we had an office building in the Southwest market in Las Vegas. It was 70,000 feet. It was 85% occupied in 2019, right? So we couldn't pay the price that the seller wanted. So we said, hey, how about you give us an option to purchase? And he's like, okay. but you got to pay my CMBS defeasance when you go and buy. Yeah, that's fine. But you have to let us put in our leasing team and our property manager. So, and you got to pay for the TIs and leasing commissions. But you keep all the cash flow. I don't charge you a fee. I don't charge you anything. I'm running this to increase the value to then be able to buy it at my strike price. Ends up being we get it to 100%, go above and beyond on what we think was possible, and we double escrow it. So we sold it to a group called King's Barn for 26, paid the broker, I think like about 500 grand, so 25.5 after closing. And then we exercised our option at, all in at like 23 million. It was like 22.7. And our money at risk was $250,000. So off of 250 grand, we basically 10x'd our investment. And so it was just like in a 2.5 year time frame.
Yeah.
So it's like, I guess like that's crazy to me. Like that, and that's on an office deal. And we set the comp at the time for the highest price per square foot in that market. And that's what we've always been able to do. We're able to set the comp, right? Like we're the guys who look and say, all right, here's the market, but what if I did X, Y, and Z to beat the market? But I'm underwriting that the deal has to work at market, but it works as like a single or a double at where the market is today. But in real estate, you have to be forward thinking. People are like, well, the comps aren't there to support it today. I'm like, yeah, but this is 3 to 5 years from now.
Yeah,
do you think the area is going to be better in 3 to 5 years from now or not? And I'm not saying the market's showing a $500 a square foot comp today, and I'm trying to get $1,000 a foot. I'm trying to say the market's 500 today, and I'm trying to get 600, maybe 650, right? I am trying to outperform it, but knowing what type of product I am doing. But usually we always try to, it depends what I'm doing. Is it Class A, Class B, Class C? How irreplaceable is the asset? Because again, real estate 101 is location, location, location.
Yeah. Exactly.
And if that location and product type is irreplaceable, then I think people are going to pay a premium for it.
I'm curious to get your thoughts on platform level investing when it comes to real estate. Much of the conversations that I've been hearing now with regards to capital emerging in the next cycle, thesis driven, they're always making posts about this, is evaluating sponsors at the platform level instead of just the single asset level. Tell us more about that.
And when you say platform level, what do you mean by that?
Like investing at the propco, like investing like in the entire infrastructure of the company instead of just a single asset. Yeah.
We've seen that on large institutional levels. I think, people want the propco or the fund structure for diversification of risk. There's a bunch of quantitative analysts that, go and put these decks together and these analysis like, oh, I might get a 40 IRR in this deal, but then there might be another deal where I get a negative 12, and then the average shakes out to the fund level is 18 or 15%. And then the pension funds get 12, right? So I think on a fund level, not like inside the company, but in through a fund vehicle is more enticing. But the problem I have with that is I think every deal has to stand alone on its own 2 feet. I think when you go through the fund structure, there's a tendency to deploy that capital. So it's like, all right, say I raised $50 million in a fund vehicle, but I only got really $40 million of quality deals. Okay, what am I going to do? I don't make my nut unless I deploy that remaining 10 million.
Yeah, the extra 10.
Yeah, the extra 10. So it's like, what am I going to go do? I'm probably going to push. I'm not going to do this because I don't have a fund structure, right? I go deal by deal. But I go and I push, and that's like where the risk really is. It's not in the first 40, it's in that 10. And how bad are you going to get burned on that 10? Especially if, like, even though the $40 million that you deployed was in good assets, say the market takes a turn, and you thought you were going to get a 20 IRR on the first 40, but you really end up only getting a 15. But on the bad 10, you go negative 15. So what is your end result IRR? Probably around a 10 or an 8. That sucks. So, and I think it's set up to be more fee-oriented, not performance-oriented. Like in these fund structures, it's usually a pref with a promote. It's like it's an annual 2% fee, and it's a 20% of the take. There's no waterfall. There's no big promote incentive. So I just don't think I think I get it from the diversification perspective. I just think you got to really understand the sponsor. I really do think from being on the road chasing capital the last few months is people are planning for longer hold periods and not as much clarity of an exit. Whereas before there's been a lot of like these 5-end closed funds or 3 to 5 year hold periods to juice those returns. But to redeploy that capital is challenging. I think you're seeing a lot more people focused on getting over 50% of the return from cash flow and not from appreciation or the sale. And that's creating a big fundamental shift in our business on, just deploying money and finding deals for that money to be deployed into.
Thank you. To round out the podcast, I have 3 more questions, Andrew.
Sure.
First one would be, you mentioned that you're a workaholic. You're 24/7 on the road. Tell us how you're able to manage work-life balance with everything.
I don't think that exists. I think, this business is a lifestyle. I got to really kind of have Wi-Fi wherever I go or cell service to just kind of keep a pulse on my deals. Maybe in 20, 30, maybe in 10 or 20 years when I got people under me doing what I'm doing, that would change. But I'm an addict. That hunt and that high of the deal is the greatest drug on this planet. Nothing beats it. And nothing beats it when everybody told you can't do it and you do it. And you exceeded the expectation of what they placed on you. So to me, I don't think it's an insecurity. I think it's more of just a reflection of just me growing up, and I was never the strongest, never the biggest, never the smartest. I wasn't even the hardest working. But, for me, I think my laziness in my youth has helped me be the most creative to get by without having to do everything. So I think in the work-life balance, it's like I used to do Ironmans and triathlons and ski everywhere and do all these things. I think that's shifted into, I have a 1-year-old daughter, I got a wife. When I'm not working, I'm with my family. I'm not out in the desert training or doing anything, and I think I reflect back to the 4-burner theory. I don't know if you've ever heard of it. You can do 3 things great, but the 4th one always fails. So it's like, okay, family, work, friends, health. Those are the 4 burners. And to me, it's work, family, health. And all my friends now are in the business. I don't really have personal friends outside of the business.
Yeah.
And so I think that's where I've made that choice. But that's how I view balance. And when I don't have to work on the weekends, my whole time's with my family. There's nothing more important to me. So it's work or family, and I try to go to the gym every day, and I really try to focus on sleep. I focus what I put in my body. I really just try to focus on that longevity. But inevitably, sometimes you just got to go hard, and you just got to kind of burn the candle at both ends, and hopefully you don't collapse. But when you can catch a breath of fresh air, you really take that time to just sleep, recharge, and get it going.
No, I completely agree. Between work and family, that's all my life. Yeah. Where do you see VAC Development in the next 5 years?
Bigger. I think in 2025, we capitalized about $110 million. 70% was ground up, 30% was value add. I think this year we might be able to do 180 to 200. So almost double
awesome.
production. And I think for me to be able to consistently transact between 150 and 250 million every year for the next 5 years is going to set us up great. I think we're going to continue to grow through strategic joint venture partnerships, just to allocate resources spread around. We're going to continue to double down on struggling GPs, more like guys who don't have the balance sheet, guys who don't have the development or back-end experience or infrastructure, and they need somebody to help get their project off the ground. We're going through that right now where one partner wants to build, one partner wants to exit. Dude, we're facilitating that transition and taking over the deal as the active developer. So I think double down on the GP, co-GP kind of things. I think eventually to go more nationwide, which is probably in the 5-year, kind of more towards the end of the 5, is, continue to allocate high net worth capital into qualified GPs. Go find operators in Indiana, Ohio, Nashville, Florida, Atlanta, North Carolina, markets we really want to be in, but physically cannot just because of flights, time, bandwidth, right. But we believe in those markets and, positioning ourselves and marketing to those operators in those markets saying, hey, we can bring you the money, we can bring in the debt, but you got to be the local guy running the asset, and we'll coach you through the institutional asset management with an entrepreneurial mindset, knowing that we're not here to go sit on decisions for a week. We're 24 or 48 hour, that's our response time. And if it really needs thought, it's a week at the max, but there's usually a reason it takes a week, because I'm going out and getting bids and other things. But I think the core is to continue doubling down with the AI infrastructure, continue to talk about more development and acquisition stuff, focus on growth markets, focus on red states, focus on business-friendly environments, and just continuing to scale up with what we're doing. That's it.
What's the best piece of advice you would give to an emerging sponsor?
Be patient. Sucks. Dude, I think play the long game. If you consistently show up every day and you really are actually doing the right things with integrity and being humble enough to know that you don't know everything, and finding good mentors or partners and being patient and having that long term mindset, you will be successful. And I like to use, I think it's a Seth Rogen quote, where he's like, if you quit, you'll never make it. But if you never quit, you'll eventually make it. You might be 50, 60, 70, but how long are you going to wait for success? To be a sponsor under 40, I think you're in the 5% of sponsors in the entire country. So to be a sponsor who's actually acquired a deal, taken a full cycle, and exited, and done it several times, I'm very curious, I got to look it up, I think you're in the 5% of overall sponsors.
5%, yeah.
Right? So it's just dude, have that into perspective. Right? Have that as your perspective. Right? And if you have that, and again, just be patient, play a long game, be consistent. And also, dude, don't go for home runs. Just go for base hits. Go for doubles. To go do these mega scale projects or anything when you haven't even done a 30 unit deal, good luck. Start small, get the track record, and then scale up. And you'll never get hurt. And again, you never want to lose people's money.
Yeah.
I've yet to lose a person's money. I've yet to do it. So I think we've lost our own money, but before, we're just chasing deals, right? Just chasing it, but I've never lost investor capital. And I'm proud to say that. So, obviously I haven't gone through the global financial crisis, so that's a little bit different, but, we're good here. So that's my advice.
Thank you. Where can people find more about VAC Development and the work that you guys do?
Yeah, I think the biggest thing is just head to our website. We post blogs, we post case studies about our deals, so vacdevelopment.com. On a more deep, real-time level, check me out on LinkedIn, Andrew M. Dunn 41, redhead kind of on there, principal VAC Development. Really love that channel, focusing on that platform. Going back to advice, I would also tell young people, double down on LinkedIn. Double down on building your online presence in the marketplace and building that through a narrative and commenting on what you're seeing in the market, commenting on data. Because what do people do now? They look you up. How do they look you up? What do they see? This guy writes about XYZ, Denver multifamily. This guy knows Denver. He writes about community events, involved in XYZ. That's a guy I should take a look at. Not some guy they can't find anything about online. It's just the age of our world today.
Yeah. Thank you, Andrew. Appreciate all the advice and coming on the podcast.
Hey, no, thanks for having me. I really appreciate it.